That live price for B2 Gold Corp, BTG, on the NYSE American Exchange is currently $4.29, reflecting an intraday dip of negative $0.10 or negative 2.28% as of 10:32 a.m. Eastern Time on November 3, 2025. This stock is trading on notably high volume, with over 12 million shares having changed hands already this morning, indicating substantial movement and heightened attention within the precious metals sector. The immediate expectation for a gold producer like B2 Gold, especially today, is that it would generally track the broader commodity price for gold, perhaps with some volatility tied to general market sentiment. However, the unexpected reality is that this downward pressure on B2 Gold is hitting right on the heels of some genuinely significant positive operational updates, creating a clear tension between recent company performance and immediate market reaction. The key insight that a lot of generalist investors might be missing is the immediate reaction to the recent news of the $10 million strategic equity investment into Prospector Metals, which, while a relatively small figure in the grand scheme of B2 Gold's total valuation, signals a renewed, focused commitment to exploration and resource pipeline expansion. This kind of active portfolio management should, in theory, be seen as a long-term positive for a gold miner, as it mitigates resource depletion risk. But the market's immediate focus seems to be elsewhere, likely reacting more to the broad, short-term profit-taking that often follows major operational milestones in the mining industry. This pattern is a recurring theme with gold stocks. The underlying metal price and the company's financial health are two different stories, and BTG's story is currently one where strong fundamentals are wrestling with a soft short-term technical chart. The common ground belief for B2 Gold over the past few months has been centered on the successful execution and transition of its new Goose Mine project in Nunavut, Canada. The expectation was that the successful commencement of commercial production in early October, following an initial gold pour, would provide a powerful, sustained tailwind to the stock price. The Goose Mine is set to be a major source of high-margin production for B2 Gold, with initial estimates pointing to robust annual output for years to come. This is the positive narrative everyone is bought into, that the substantial capital investment is now transitioning into tangible ounces-in-the-bank production, justifying the stock's push higher earlier in the year. The market was essentially pricing in the certainty of this new production stream. However, the contrarian or deeper take is that with the Goose Mine now hitting commercial production, the market switches from future growth project to current operational execution. The reality now involves the market scrutinizing the ramp-up speed, the all-in sustaining costs in the early stages, and the near-term cash flow contribution, especially in the context of recent, slightly revised production guidance for 2025 due to initial crushing plant capacity issues. The market is very forward-looking, and now that the big news of Goose has passed, traders are looking for the next catalyst. Today's price action, with the stock moving lower on high volume, suggests a segment of the market believes the near-term operational challenges and the full impact of the investment spending may not be fully discounted yet, leading to short-term weakness, regardless of the long-term potential of the asset. This dynamic is one you have to constantly manage if you use services for self-investing, such as setting stop-loss orders on a platform like Interactive Brokers or using a robo-advisor like Schwab Intelligent Portfolios to keep your asset allocation balanced. To expand this analysis, let's look closely at the stock movement. Over the last month, B2 Gold has traded in a notably wide range, moving from a high near its 52-week peak down towards its recent lows. This volatility is typical of a mining stock in a phase of significant capital expenditure completion and operational ramp-up, exacerbated by the inherent volatility in the gold price itself. The high trading volumes we're seeing, both today and on recent downswings, underscore a significant level of institutional and retail activity. Looking at the technical picture, the stock has fallen below its short-term 20 and 50-day simple moving averages, a signal that short-term momentum is decisively negative. While the long-term 200-day moving average remains positive, indicating that the multi-month uptrend is still intact for now, the short-term negative trend is what's driving today's pressure. This mixed picture, a positive long-term trend fighting a negative short-term trend, is a classic scenario where self-directed traders using platforms like Robinhood for Robinhood stock trading might be tempted to jump in on the dip, potentially utilizing fractional shares, while more conservative, long-term investors utilizing services like Fidelity for their Fidelity investments or consulting with Fidelity Wealth Management might be pausing to wait for clear signs of stabilization. The high average true range we see confirms this elevated volatility, signaling that traders should expect wide daily swings. Institutional activity in the past quarter, based on 13F filings, showed a mix. A large number of institutional holders increased their positions, while a slightly smaller but still significant number decreased or sold out. This conflicting institutional behavior illustrates the expectation versus reality tension perfectly. Some large funds are seeing the long-term value in the new production, reality, while others are cashing out on the recent run-up and managing near-term operational risk, an expectation of a pause. The presence of large institutional names like VanEck and Vanguard in the ownership structure suggests B2Gold is a serious contender in the gold space, not just a speculation for retail investors using investing sites like SoFi Invest. The broader macroeconomic pressures are also critically important here, as with any gold stock. The price of gold itself has been range-bound recently, caught between persistent inflation concerns and central bank buying on one side, and the ongoing strength of the US dollar and rising real interest rates on the other. BTG, as a gold miner, is essentially a leveraged play on the commodity. A flat or slightly declining gold price puts immediate pressure on the stock, forcing investors to focus solely on the company's production efficiency and costs. The stock's performance this year has actually been quite strong relative to the broader market, outperforming the S&P 500 over the past year. This outperformance creates a psychological hurdle. When a stock has run up, any slightly negative news or even just a lack of new, overwhelmingly positive news can trigger profit-taking. The market is also keenly aware that B2Gold is due to report its third quarter 2025 financial results soon, which will provide the first detailed look at the financial impact of the Goose Mine ramp-up and a clearer picture of the all-in sustaining costs moving forward. The expectation is solid production, but the reality might be higher initial costs as the new mine works through its commissioning phase. This pre-earnings uncertainty is another major component of the recent selling pressure. When you manage your online investing portfolio, whether through an individual brokerage account or a managed service, these sector-specific pressures are essential to grasp. Turning to the core business model, B2Gold Corp is a low-cost senior international gold producer with operating mines in Mali, Fekola, the Philippines, Masbate, and Namibia, Otjikoto, in addition to the new Goose Mine in Canada. Its business is relatively straightforward. Extract gold at a cost significantly lower than the market price, and generate substantial free cash flow. A key part of its appeal is its geographical diversification, though this also introduces headline risk, particularly from West Africa, where they have a significant presence. Historically, the company has excelled at operating its mines efficiently and has maintained a strong balance sheet, which is a major positive in an industry often burdened with debt. A brief look at the past performance confirms this. The The company has consistently met or exceeded production guidance from its established mines like Fekola, which continues to be a top-tier asset. They also boast a strong dividend yield compared to many peers, a factor that appeals to income-focused investors who might use platforms like Fidelity for their Fidelity IRAs or a brokerage account at Interactive Brokers. However, it is important to remember that they recently announced a change in their intended quarterly dividend rate to conserve capital for their growth projects. A prudent financial move, but nonetheless runs counter to the expectation of a steadily increasing dividend, causing some short-term disappointment for income investors. This move signals a management team focused on funding organic growth from internally generated cash flow, which is a sign of long-term financial health, even if it causes a temporary dip in the stock price. The fact that the dividend is paid from actual free cash flow, unlike some of its peers,